Welcome back. CNBC is now starting to take submissions for our next Disruptor 50 list. But the environment for startups, it's a little different this year than in lists past. Julia Boorstin is here to explain.
Well, Kelly, right now it's a rough market for startups. The third quarter saw the lowest overall venture deal value in 6 years and the lowest number of deals in 3 years, with U.S. VC funding this year on pace to set a 9-year low. Plus, companies that are managing to raise funds increasingly are doing so at lower valuations. The number of down rounds in the third quarter climbed to a 10-year high, with 26.4% of rounds completed year to date done at a flat or reduced valuation. Now, lack of access to capital means more companies are going out of business. Carta reported that 87 of the startups on its platform that had raised at least $10 million had shut down this year as of October. That's twice the number of companies that shut down in that same category for all of last year. And now, after only 27 companies went public in the third quarter, there is a pileup of companies waiting to go public, 75 according to PitchBook, including some big names such as Stripe and Chime. And as we look ahead to our next list, it's worth pointing out that our first 11 lists have identified some outperformers. Our Disruptor 50 index, companies that have gone public from our Disruptor 50 list, is up 28% year to date versus the S&P 500's 19% gains. So now we are looking for private company nominations for the 12th annual Disruptor 50 list, which will debut in the spring. To learn more, scan that QR code on your screen or go to cnbc.com/disruptors.
What is the classic description of a disruptor for this contest or competition?
Well, what I have to say is when I founded this list 12 years ago, the idea was to look at how technology is disrupting every single industry. So what we see every year is companies not just in sort of stereotypical tech industries. Yes, we have a lot of AI. OpenAI was the #1 company on the list last year. But we also see companies in the ag tech space, in logistics, even in retail. So there are all sorts of different ways people are using technology to disrupt their respective industries. The companies do have to be private. They're usually venture-backed. And the idea is to find the fastest growing and most disruptive companies. So really ones that are prompting change in their industries.
And you said the number of deals are down, the number of companies that are going public are down. What do rising and the number of bankruptcies are up? What do rising interest rates have to do with all that?
They have a lot to do with it. I was actually talking with my colleague Bertha Coombs about the biotech space, because two areas which have remained relatively resilient relative to some other categories are AI-based companies, no surprise, but also biotech in the life sciences field. And she was saying that rising interest rates have hurt that category because those are so cost-intensive. Those types of companies are so cost-intensive. You're not just launching an app. And we have seen that negative impact throughout the space. But also remember, we had that Silicon Valley Bank implosion this year. So that has had an impact as well. And overall concerns about the economy. So there have been so many different factors that have put pressure on this market. But a lot of investors have said this is a great time to get in because valuations have come down.
All right. Julia, great to have you in the house.
It's great to be here.
Appreciate it.